Hey guys, what's up? This is Andrew for TRENDLINES.com. So in this video, I would like to show you how to compute yourself the synthetic short interest. And most importantly, I would like to show you what I have for AMC compared to the other stocks and see what this means in terms of market dynamics for AMC. So let's get into it. All right, so very quickly, I'm showing you the chart here again, but I've already done an analysis using this data during the weekend. So not much to say. Let me just remind you the most important information in this technical analysis is that we have the breakout here around 34.5. I moved a little bit this trend line to be really, closer to the price action on the short term. Here I matched the high and here the low. So this is the proper trend line I want to have. And we are retesting this upper band here, the blue one, perfectly. We are moving higher. This looks very good to me. But once again, AMC price action is full of tricks, especially for the past month, 2 months. But this is kind of, I would say, happening often during those correction phases. They're very hard to trade. A nice bullish move is much easier. It's respecting much better every ratio and all the technical analysis tools that we can use. So here, just to conclude, we need to see the price trending above 34.5, closing ideally on the hourly time frame above this level. And so means one full hour of trading above 34.7. Let's be very precise, 34.7. This would mean further upside movement for me, probably going to 40 or 46. But here, guys, what I want to show you, because I fixed my spreadsheet, so you didn't see this for a while. Okay, very quickly, it's not this one, sorry. Okay, it's this one. I'm using here Bloomberg data. So that's why I couldn't use it for a while because, I had the Bloomberg license from my company. Now I took my own Bloomberg license. So I'm not allowed to show you the details of this analysis, but I can show you the conclusion. So basically what I'm doing is that I get all the open interest, option open interest for every strike, every maturity. All right, guys, you can see this is what I put in here. Okay, so I take the strikes from 11 to 200. So basically I have all the strikes, every maturity. My maturities are here, guys. And I just compute the delta myself for every volatility. So that's why I need Bloomberg to get the volatility. As you can see here, this is a Bloomberg formula. So this is the reason why without Bloomberg, it's impossible to get, or you need to have other information that gives you the volatility per strike, per maturity. Then it's just basic Black-Scholes formula that you apply, and you get all the open positions for the call options. I'm only here considering the call options, which is a fair assumption. I don't take into account the put open interest, because you never know who is long put. Okay, you know that retail is long call, so you know that market makers are short calls or hedge funds. So you can guess the dynamics on this market because you know that those guys, they are usually hedging the position every day, but you don't know who is buying the put options. They can be retail that protect the long share position, and it can be also hedge funds or market makers betting on an AMC crash. So that's why I don't take here into account the put open interest, which is anyway much lower. And when I compute this for AMC, guys, I have right now, so you can see per strike here in yellow, it's the number of shares. So you can see that the highest number of shares is here, guys. For the 145 strike, we have 145, 14 million equivalent share sitting here. All right, so this is very unusual. Here is the option open interest breakdown per strike, and you can see that we have a lot here, definitely, but we have a big one here. Those are a bit small to me, and if you take the sum of it, you have 6.3% at the current spot, and it can reach 15% if all the options are finishing in the money. So this would be, for example, a price of AMC equal to, I don't know, if AMC goes to 200, you can see that we are converging towards this. And if AMC goes to 500, okay, we are very, very close. So it's almost a perfect convergence. All right, so this is the first important thing I wanted to show you. So we have 6.3% of synthetic short interest. We have 16.7% of synthetic regular short interest. So the sum of it is 23%, which is a lot. Let me show you, for example, another stock that is trading, that has a normal open interest. I just take Apple, for example, bam. Okay, you're gonna see. So now everything is messed up. Now Apple is not too bad. You can see all the information is here. So we have only 0.6% of synthetic short interest, okay? And regular short 0.6%. So you can see the difference between Apple and AMC. So this is a normal stock, all right? So basically you can see that the synthetic short is, the maximum is 1.4%. Now, if I go, for example, to GME, very interesting. Let's have a look at GME. Bam. So here, my strikes are not good, so I need to update it. Bam. So I'm updating. You're going to see the magic happening. Okay, I'm just rebuilding everything here. All right, here we go, guys. So you can see that the option open interest breakdown per strike, there are a lot everywhere, but you have a bit less on the very high strikes, around 300% than you have on AMC, but the maximum synthetic short is still 13.7%. So it's still very, very unusual. But as GME is quite low, we only have 3.6% of synthetic short at this spot. But once again, if GME goes, I don't know, to 4 times this, okay, you can see we go to 10%. So this is, what is forcing the market makers and hedge funds to buy back their positions if the price is going higher. So this is the first information I wanted to show you. Maybe we can do one more. I don't know, just for, we can do Tesla. Okay, bam. Tesla US, get synthetic short. Okay, I'm recomputing everything. Give it some time. Okay. For now, this is not correct. It's still using past data. Don't worry, it's going to reset soon. Okay, here we go. So you see, Tesla is actually not that much shorted on the regular market, only 3%. But look at the very high synthetic short, for example, on Tesla. So this is interesting. It means that a lot of people don't believe Tesla can go to 1,000 or 2,000. I mean, a lot of people believe this and market makers are ready to sell it. Let's have a look at the volatility, for example, on Tesla. It's interesting, because market makers, they're going to sell it if the vol is very high, but I don't think the vol is very high. So let's see first where these big positions are coming from. So which is the biggest one? For example, the 1,000. 1,000 is quite big. So I go to the 1,000 strike. Okay, I have 6 million equivalent share. Let's see where it's coming from. Okay, so mostly from here, 22,000. Okay, so mostly from Gen 22, Gen 23. And the volatility, guys, is not that high. It's only 50%. So to me, this is a very actually nice trade to do, to go and buy this volatility because it's not high. For AMC, guys, it's around 200% on the same strikes. 150% strike. Let's have a look for AMC. What is the volatility? Okay. So 145 strike. 150%. You see volatility is around 120, 130%, depending on the maturity you look at. So it's 3-4 times more than Tesla. So for this reason, you actually don't want to be buying this 145 strike, but it's kind of maybe a worthy sacrifice because it's very expensive. It's free money for the market makers as long as AMC is trading below 145, but this is as well what is creating this gamma squeeze. Let me explain again. When AMC goes higher, those market makers position that are shorting those 145 strike calls, their short position increases in the same way that the long position of the call options holders is increasing on the upside. So those guys that are selling it, they become short, so they have to buy back some shares, to buy just some shares in order to be hedged, because market makers don't keep a short position overnight. So that's why they need to buy whenever the spot is going higher. But I'm very sure you guys heard it already everywhere, because it's something that many people talk about, but I just wanted to explain it once again quickly. So it's good that some people buy it because it's going to help to create the squeeze. but this is a waste of money. Let's be honest. All right. When you buy such expensive volatility, it's not good. So this is the reason why what I am showing you guys here, and I'm going to discuss this with you guys that are on my Discord tonight. I just want to add some cool features in this option strategy builder spreadsheet. So for example, for AMC, you can see that the kind of strategy that I'm proposing you guys. So here you have the maturity. So let's go, for example, for the September maturity. It's good because let's imagine that this week we go much higher and that the squeeze begins. You don't know. So maybe we're gonna here, I don't need this one. Okay, so this is the kind of strategy that I showed you guys already. I'm going to keep showing you this kind of strategy, what I'm doing here. So let's start from scratch. Okay, first 24 is support. I'm talking about this for a long time, so I'm not scared to sell this put. All right, this is free money I can get. So now that AMC spot is higher, it's not worth a lot, but it's still interesting to sell it. Then you can buy 140 strike call. Why 40? Because 40 is a support level. All right. So by doing this, the call option costs $370, but you reduce it by 140, and we're going to keep reducing it because as you saw, the very high strikes have a very high volatility. Look here, 137, 132, and this one is 245%. So guys, don't buy this high vol strikes. Okay, you sell it, but you're not going to sell it by itself naked. You're going to buy the 40 strike before, so you have a long position. So here we sell it, bam. And by doing that, we reduce again the premium we pay. By doing that, you're going to pay $150 in premium, and you can make up to 8,000, even 9,000 US dollars if AMC goes to 130. What you can do as well, if you don't want to spend any money, you go to 50 strike, and now it's for free. So because the 50 strike call is less expensive than the 40 strike call. The only difference is that you're going to start making money only here. I want to add some features. I think we can add a lot of things. I can add the gamma, the delta, the vega. And I want to walk you through this once again tonight or tomorrow, guys, on my Discord. So go there, and I will try to show you a lot of different option strategies on many stocks. I will also try to show you, the option open interest if you're interested, anything that can be helpful for you guys and that I think is important to understand to better analyze market dynamics and price action. So that's it for me. I hope you guys enjoyed this video. And if you did, please don't forget to click on the sub, like, and bell button so you're going to be the first to know when I upload anything new. And stay close to shore. See you guys.